welcome to UBS Trending. I'm Anthony Pastore. With the amount of news circulating today, including the fear of continued volatility, market breakdowns, or even questions of a recession, it's not surprising that investors might have some concerns. And I'm going to talk about those right now with my guest, Rich Bernstein, CEO and Chief Investment Officer of Richard Bernstein Advisors. Rich, thanks for joining me. Great to see you, my friend. It's been a while, and so glad you can take some time for us today.
Yeah, great, Anthony. Thanks for the invitation to speak.
Anytime, Rich. So let's get into it. First of all, we are continually monitoring the war in Ukraine. Our thoughts go out to the people of Ukraine first and foremost, as always. And then we're watching this humanitarian crisis unfold, which is devastating. But of course, there are so many economic implications. So I wanted to ask you, as you're looking at this, what are the implications of a continued war in Ukraine? And if you add to that, there's constant back and forth about, is China going to get involved? Are they not? What happens if they actually get involved as, a large economy themselves?
Right. So, Anthony, it's clearly a horrible situation, no matter how you look at it. But I think, look, the main theme that investors should take away from this is that globalization is now significantly contracting, right? I mean, we went through a period where globalization was expanding. Now it's contracting. That's not unusual. Historically, globalization has been like an accordion. It has expanded and contracted and expanded and contracted. And right now, we're contracting pretty heavily. The investment implication of that is that we should begin to think about more secular inflation, not what's going to happen the next 2 weeks, but higher secular inflation than people are used to. Now, some people will say that's an incredible threat. I would argue it's an incredible opportunity because this all comes at a time when investors are generally underweighted what we like to call pro-inflation assets. Now, Anthony, just to try to head off one of your questions, you might say, well, why does this mean more inflation? And the answer is because globalization was the prime reason that the United States had secular disinflation. Globalization did exactly what your textbook said it should do. Production went to where it was most efficient. Of course, we could argue whether all countries are competing fairly or not. That's a story for another day. But production moved to where it was most efficient, and the United States, not being an efficient producer, it moved offshore. And you see that in our ever-expanding trade deficit of the last 30 years. And what that means is that as globalization contracts, production is going to have to shift to where it's less efficient. Less efficient production means higher prices.
Right. It looks like that secular disinflationary trend you were talking about in the U.S. was sometime back in 2017. So it seems like since then, and especially over the last 2 years with the pandemic, inflation has really taken off here. And this actually brings me to the part of the conversation I want to talk about with you on the domestic side. We know now the Fed raised rates by 25 basis points last week, which was widely expected, but they also raised their inflation forecast to 4.3%. So from a market perspective, Rich, do you see more opportunity in the fixed income markets given where rates are trending? And, subsequently, what do you think this is going to do to inflation trends?
Right. So, Anthony, I think, my previous comment about that people should expect higher, not lower, secular inflation going forward, right? Now, and let's talk about that for a second. That only means, forecasts for secular inflation are only about 2 to 3%. So all you really have to do is say, will secular inflation be 3% or higher? It's not a major bet, but the expectations are still so low for secular inflation. That's important for fixed income investors. Why? Because during the decade of the 1960s and during the decade of the 1970s, fixed income was the worst performing asset class. It gave you low returns and high volatility. So what that means is that we may be changing fixed income money management right now. I mean, let's be honest. Most fixed income strategies have really just ridden the wave of secular disinflation and secular falling interest rates for probably my entire career, my 40-year career. If that's changing, it means that fixed income investors are going to have to be more creative. They're going to have to be more tactical. They're actually going to have to be active managers, which most fixed income investors aren't used to at all.
Yeah, it's a really interesting time. Now we've got the Treasury, 10-year Treasury at about 2.25. And interestingly, on the consumer side, we're seeing the 30-year fixed rate mortgage at around 4.5%. And that's up 22 basis points from just a week ago. So do you see, the housing market is something we've been discussing so heavily because, and every friend I talk to who's looking for real estate is thinking maybe this isn't the right time, there's low inventory and the prices are high. Do you think that we could maybe see a cooling off here now that rates are going to be trending a little bit higher on the mortgage side?
Right. So Anthony, the key word you said was cooling off. Yes, you might see a cooling, but it won't get cold. It's still going to be pretty hot. And the reason that I think that's the case is, as you mentioned, the inventories are low. You still have pent-up demand. Incomes are rising. This is not the kind of environment that would say that we're heading for recession, right? Labor markets are still very tight. Wages are going up, all those kind of things. So, yeah, it's entirely possible we will see a cooling of the housing market as mortgage rates go up. That would be perfectly normal. Whether we're going to see it turn cold and force the economy to slow down dramatically, I think that might be a little bit extreme.
Yeah, a lot of potential buyers out there are looking for a cold winter on housing. But yeah, as you said, may not be in the cards just yet, right?
Exactly. Wishful thinking.
That's right. And on the inflation side, I know we've talked about that a little bit. And one thing that we're all tracking is that right now in China, there's another COVID outbreak for them. 50 million plus folks are now quarantined. That could potentially affect supply chain again. What do you think about inflation? Could we maybe level off a little bit halfway through the year, maybe head a little bit lower before year's end?
Well, Anthony, you mentioned supply chains. I think it's very important for everybody viewing this to understand that the supply chain disruptions that we already know have now lasted 2 years. That 2-year period is longer than the 73-74 oil embargo and the 1979 oil embargo combined. So this is a major economic event that is changing the global economy as it goes. This is not something that's just going to go away and we're going to wake up tomorrow and it's going to be 2018-19 all over again. This is a major economic event. You're seeing this in terms of the way companies are anticipating price increases. You're seeing this in terms of wages and everything else. So we are actually in a wage and price spiral right now that's not going away anytime soon.
And one last thing I wanted to ask you, Rich. You mentioned recession there 2 or 3 minutes ago, and the question is coming up a lot from investors expecting that we might see a recession in the next year to year and a half. And look, you and I both know we've seen recession time and time again. They're not all 2008 and 2009 level.
Right.
It could just be 2 quarters in a row of negative GDP, so it could be a mild one. But just from a recessionary perspective, do you think we might see one in the next 12 to 18 months?
Anthony, we could. I emphasize the word could. So far, there is virtually nothing that suggests that a recession, let alone a major recession, is in the cards in the near future. The leading indicators, I emphasize the word leading, the leading indicators came out last week and they actually strengthened a little bit from an already very healthy framework. So it's not like we're on the precipice of bad things happening here in the economy. Is the economy changing? Are we shifting to more inflation rather than less? Will there be changes in growth? All these things are going to happen, but it doesn't mean that it's time to get under your desk in the fetal position. That's a far cry from where we are right now. That's
right. And Powell last week during his press conference really did play down recession fears as well, saying that we were in a very strong economy and an economy that could actually handle tighter monetary policy. So there we are, right on par with what Powell's saying. Hey, Rich, thank you so much. It's always a pleasure to have you. Please come back again soon. Good to see you.
Good to see you, Anthony. Thanks.
Thanks, Rich. And for more information from anything we talked about on the UBS side, there's lots of content there from various groups, including our Chief Investment Office. You can visit our public website at ubs.com/views and make sure to follow UBS on social media. We've got LinkedIn content, Facebook, Instagram, Twitter. Plus, you can check out all of our past UBS Trending episodes on demand. And as always, if you have any questions about anything that Rich and I spoke about today or how it could impact your own portfolio, make sure to speak with a financial advisor. And until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.